Hi everyone, welcome to CAGM Care Private Limited, where we empower businesses through data and intelligence. With a dedicated team of chartered accountants and data analytics, our expertise spans across business data analytics, business process automation, internal audit services, risk assessment and management services. We also provide top-class best consultancy services in company law, income tax, goods and service taxes. Hi everyone, in this video I am going to explain about income tax for salaried individuals. There are two ways of collecting taxes. One is through direct tax, other one is through indirect tax. Income tax falls under direct tax. That means government collects tax directly from the individual who is earning income. The person who earns income need to pay tax on such income. Other type of collecting tax is indirect tax. That is government collects taxes from individuals through expenditure individual makes. For example, we buy a particular product from shop or market for 100 rupees. If you check the bill of that product, GST portion is included in that 100 rupees only. Tax is deposited by seller of the product to the government, which is indirectly collected from the buyer of the product. Income tax is the tax which is collected by government directly from the individual who earns income. Indirect tax is the tax which is indirectly collected by the government from the buyer of the product or services. Coming to the practical scenario, what are the major issues facing by employees? Most of the employees not interested in knowing the tax structure, what are the tax rates, what are the different tax slabs under income tax. They are only interested in maximizing their refunds at the time of filing income tax returns, which has become a major issue recently. Income tax department has issued many notices, especially in Telangana and Andhra Pradesh region, who claimed heavy refunds. I advise all salaried employees to focus on understanding the income tax structure, what are the income tax rates for different slabs, what are the deductions available under income tax, how to plan and save their taxes in purview of income tax law. Coming to the next, what is financial year and what is assessment year? Most of the people gets confused between financial year and assessment year, or either they don't know what is financial year or assessment year. In India, we follow financial year, that is April to March. Most of the countries follow calendar year, that is from January to December. In India, we use financial year for closing books of accounts, assessing financial accounts, for parenting budgets, assessing taxes, and filing income tax returns. Once the financial year closes in March, the next step is assessing the financial accounts, finalizing them, and paying tax in the following year, which is called the assessment year. For example, if 22-23 is the financial year, the following year is called the assessment year, that is 2023 and 2024. If you check on income tax return filed for financial year 22-23, you will see the assessment year 23-24 mentioned in the top right corner. Now let's understand the basic exemption limits under the income tax. As most of the people know, there are two tax regimes under Income Tax Act with different tax rates and different slabs. First, we'll go through the tax rates and tax slabs under old tax regime followed by new tax regime. First, we will understand what is basic exemption limit. Basic exemption limit is the maximum amount of income which is not chargeable to tax under the Income Tax Act. If a person is earning income below basic exemption limit, he no need to pay any tax and no need to file income tax return also. Once the person's income exceeds the basic exemption limit, he comes under the purview of Income Tax Act and he needs to file income tax return. Basic exemption limit under old income tax regime is 2.5 lakhs. Means up to 2.5 lakhs, we no need to file income tax return. 2.5 to 5 lakhs, tax rate of 5%. 5 to 10 lakhs, we need to pay tax of 20%. Here important thing is 5% tax rate is applicable on income between 2.5 lakhs to 5 lakhs. 20% tax rate is applicable on income over and above 5 lakhs. Once SC crosses the income of 10 lakhs, tax rate of 30% is applicable. Now coming to the income tax slabs and income tax rates under new tax regime. Under new tax regime, up to 3 lakhs, there is 0% tax. Income between 3 to 3 lakhs, 5% tax is applicable. Income between 6 to 9 lakhs, 10% tax is applicable. Income between 9 to 12 lakhs, 15% tax rate is applicable. Income between 12 to 15 lakhs, 20% tax rate is applicable. And if individual crosses the income bracket of 15 lakhs, maximum rate of 30% is applicable. If we compare the income tax rates and income tax slabs under new tax regime and old tax regime here. In new tax regime, for every 3 lakhs increase in income, increment of 5% in tax rate till 15 lakhs. After that, maximum rate of 30% is applicable. Under old tax regime, point to be noted is maximum rate of 30% is applicable starting from the income of 10 lakhs. Under new tax regime, maximum rate of 30% is applicable starting from the income of 15 lakhs rupees. Prima facie, if we see this income slabs and income tax rates, new tax regime is beneficial. But the point is, If you opt for new tax regime, you will lose the opportunity to claim various deductions available under old tax regime, which is not available under new income tax regime. Now coming to the major deductions available under old income tax regime, one of the major benefit available under old income tax regime is ATC. What are all the deductions, investments covered under ATC? Life insurance premium, provident fund deducted by your employer, or self contribution made by the employee, subscriptions to certain type of equity shares and mutual funds, tuition fees paid to children, investments in national savings certificates, housing loan principal, and other various items. These are the major items under ATC. Maximum deduction under ATC limits to 1,50,000 here. Even your total deduction under ATC comes to 2 lakhs or 3 lakhs, 4 lakhs. Maximum deduction available under ATC is only 1,50,000 rupees. Other major deduction under old tax regime is 80D, medical insurance premium, paid to self, paid to family, parents, and 80E interest on educational loan, 80EB interest on electric vehicle loan, 80G donation made to charitable trust and institutions, 80TTA, TTB, savings bank interest. These are all the major deductions available under old tax regime, which are not available under new tax regime. And another major exemption which is available under old tax regime and not available under new income tax regime is HRA exemption. One of the major exemptions employee can claim to lower their income tax payment. Coming to interest on housing loan under section 24B for self-occupied property, which is available under old tax regime, is not available under new income tax regime. One of the major tax saving item under old tax regime is National Pension Scheme contributions to NPS. In NPS, there are totally three parts. One is 80CCD1, second one 80CCD2, third one is 80CCD1B. Employees' own contribution covered under 80CCD1. Maximum amount of employee contribution is up to 10% of basic salary plus DA, which is again form part of total limit of 1,50,000 under ATC. Second part under 80CCD2, only employers' contribution to NPS is considered. This is over and above the ATC limit of 1,50,000, and this forms major tax saving item under old tax regime. Maximum contribution allowed under 80CCD2 is 10% of basic salary plus DA. In case of central government employees, it is 14%. There is no monetary threshold limit under section 80CCD2. Whatever the 10% of basic salary in DA totally get deducted from salary for tax calculation purposes. And the main point to remember here is there are only two deductions allowed under both new income tax regime and old income tax regime, and 80CCD2 is one of it. It is available under both old tax regime and new income tax regime also. And other NPS contribution is 80CCD subsection 1B applies voluntary contribution to NPS account. Only contribution to tier 1 account is covered here with monetary limit of 50,000 rupees per year. Actually, there are many other deductions available under old tax regime which are less frequently used, such as 80U deductions for an individual taxpayer with disability, 80E, 80DD, 80DDB, 80GGC, etc. There are only two deductions available in new income tax regime. First one is 80CCD subsection 2, employer's contribution to NPS, and second one is interest on housing loan under section 24B for a let out property. Now coming to the dilemma between selecting old income tax regime or new income tax regime, it solely depends on amount of deductions individual has. If an individual having higher amount of deductions, old income tax regime is beneficial for him. If a person having less income tax deductions or no income tax deductions, new income tax regime is beneficial for him. This scenario will change from individual to individual based on their income tax slabs and income tax rates. As an example, we are taking an individual having 20 lakh salary after standard deduction of 50,000. Standard deduction of 50,000 is available under both old income tax regime and new income tax regime, and having deductions of 3,72,800 rupees. And these deductions covers HRA, ATC, housing loan, others, etc. Tax under new income tax regime comes to 3,12,000 rupees. Tax under old income tax regime comes to 3,12,686 rupees. Means new income tax regime is beneficial for this person. What is the break-even point of deductions where income tax under old tax regime and new tax regime is same? Is 3,75,000 rupees. Deductions of 3,75,000 rupees. Tax under new tax regime and tax under old tax regime is same. Here we will make trial and error by decreasing and increasing deductions and compare the taxes under old tax regime and new tax regime. We are making this HR deduction to 1 lakh. Total deductions are 3 lakhs rupees. Tax under new tax regime is 3,12,000 rupees. Tax under old tax regime is 3,35,400 rupees. Conclusion we can draw from this scenario is lower the deductions, new tax regime is beneficial. Now we will make another scenario and increase total deductions to 4 lakhs rupees. What happens here is tax under new tax regime is 3,12,000 rupees. Tax under old tax regime is 3,04,200 rupees. From both these scenarios, what we understand here is higher the deductions, old tax regime is beneficial. Lower the deductions, new tax regime is beneficial. And break-even point of deductions where tax under new income tax regime and old income tax regime is same is 3,75,000 rupees. For people who do not have tax knowledge previously may find it difficult to understand. So I suggest you to download the sheet from the link I provided in the description box and enter your salary and deduction details and find out which is beneficial in your case. Here are some straightaway estimates to help you decide between selecting old income tax regime and new income tax regime. If you having total deductions less than 1,50,000 rupees, straight away you select new income tax regime. If you having total deductions more than 3,75,000 rupees, straight away you go for old income tax regime. When your deductions ranges between 1,50,000 and 3,75,000 rupees, you download the sheet from the link provided in description. Enter your salary and deduction details. It will give you tax under new tax regime and tax under old tax regime. Under whichever tax regime income tax is lower, you select the tax regime.